Hello, everybody, and good afternoon. It is your man, Charles Tank Harris, the CVO, founder of the financial planning firm, Wealth Our Way. This is a special day today because I am doing a webinar as opposed to the normal 15 minutes of finances. I'm going to do probably about an hour broadcast. That was the result. This broadcast is the result of a debate that was had last night on Instagram. Now I got to tell you, your boy Big Tank. You see the gray hair. I'm grown. I'm old. I'm a grown man, and the technology is not what I'm good at. I got children. I have people that work with me who are good at technology, and they help me with a lot of these things. When it comes to technology, I'm just not necessarily on it. I believe the brain is a computer, and the computer has but so much space, storage, memory, RAM, whatever you want to call it. I choose to have my brain ready for financial things. I don't choose to be all up on technology when I can get someone to help me with that. With that being the case, the reason I bring that up is last night. So as a financial planner, I'm constantly suggesting various avenues for my clients to take to prepare for their financial future. Everybody's situation is different. I was on the phone yesterday with a longtime, very dear friend of mine, Nicole Purvey, the founder of Better Than Success Real Estate League. I call Nicole Shine because she shine like the sun. That's my girl. So I said, Shine, she was talking about getting some insurance for her baby, her newborn, my nephew, JD. And I was telling her that, although I don't sell insurance anymore, I still advise to my clients on how to get it. I have brokerage relationships. Everybody who knows what Wealth Our Way does or doesn't know, let me say this, because even Nikki and some of her quotes and some of her posts on Instagram put it a little differently. I've had clients for 22 years who ironically couldn't tell you what I do. They just say, Tank's my money guy. So let me be clear on what I do. I am a financial planner. As a financial planner, I don't sell products, whether it's investments, whether it's insurance, anything that's a product, I don't sell. So when I was growing up, there was a company called BASF. I love their commercial. The commercial said, BASF, we don't make the products you buy, we make the products you buy better. So that's a little bit about what Wealth Our Way does. We don't sell you homeowners insurance. We don't sell you life insurance. We don't invest your money, but we create plans for our clients that let them know this is what you need to do. If they already have people that can supply them with the things that are part of their plan, they go with that. If not, I have a litany of strategic partners that help with every aspect of your finances, from banking to credit, to investing, to insurance, whether it's life, property, casualty. If it's something that you're going, I know car dealers, if it's something you're going to spend money on, you come see your man, Big Tank, the money guy, and I put you in the right direction. My clients pay a fee for financial planning. Now, to take it a step further, why you guys come here every day is I've taken it and lifted up the game, so to speak. I've made a great deal of money. I've been blessed being in financial services the way I've been. And as a result, I decided to make a platform for my people who come from the neighborhoods that I grew up in, the similar economic background, people who I ascended and went to college with, people who I've met along the way who make halfway to very good livings, but major brokerage firms wouldn't let them in. I always tell this quick story, and when I tell the story now, because Lord knows where this will be broadcast, I won't use the company's name. When I moved to Atlanta in 2008, I left being a business manager in Philadelphia after having been an investment professional for a few years, and moved to Atlanta to expand my business management firm, the Sports and Entertainment Financial Group. I had about $50,000 in an IRA, and I had one set up for my then wife. It was $40,000 in hers. I knew a cat brother was working at one of the major brokerage firms. He asked me if he could manage my IRAs. I said, sure, do your thing. He was there, and what happened is what happens a lot. He left the firm shortly after taking my money, and he left about a year later. I get a letter in the mail from the firm stating that I don't meet certain account minimums. And as a result, they were not going to assign a new representative to my account. It didn't bother me. They told me I could call this 800 number if I needed help. It didn't bother me because I've passed the Series 7, Series 63, Series 65. I can invest my own money. I didn't need anybody's help, so I wasn't mad. What did make me mad was a few months later, I'm on the road all the time with my job. I come home, stack of mail. In the mail are two checks from this brokerage firm. One for a disbursement from my IRA, one a disbursement from my then wife's IRA. Now, mind you, I don't know how much you've listened to Wealth Our Way and understand IRAs. I've talked about it before. You have 60 days when money is taken out of your IRA to successfully roll it into a new IRA, or you are taxed on that money. And if you're under the age of 59 and a half, which I currently am and definitely was back then, you're penalized an additional 10%. So on roughly 100 grand, that would have been added to my household income. My tax bracket's the max tax bracket. So you're talking about on 100 grand, 37,000 of federal tax, 5,000 state of Georgia tax, and 10,000 in penalties. Because these people didn't think highly enough of me and my business, they almost cost me over $50,000. That's the bigger IRA. They were going to wipe it out. That is the way major brokerage firms treat small people. That is the way they treat people who are trying to get on their feet financially. Banks are not much better, but we're working with banks and brokerage firms currently to try to get our people treated better, which is why this firm is called Wealth Our Way. So going back to what happened last night, when Shine called me up and we started talking about illustrating a plan for JD, we talked about using a limited pay whole life insurance policy. Now, I've talked about this on previous broadcasts, but I'll educate again right now. When you have a whole life insurance policy, the premiums on that policy are expected to be paid until age 100. Now, there are various things you can do. If the policy grows big enough and has enough cash value, you can stop sending in your premiums and let the premiums be paid from the policy. But what I was suggesting wasn't a regular whole life. I was suggesting a limited pay whole life. A limited pay whole life is contractually obligated to stop receiving payments after a certain year. So now you don't have to worry about premiums being paid out of your pocket or out of the policy. It's paid. It's a paid up policy at a certain year. Now, of course, if we're comparing apples to apples, if we have a policy that you're supposed to pay for to age 100 versus a policy you're only supposed to pay for 15 years, the premiums that you're going to pay into the shorter policy pay in are higher. Let me tell you about where this concept first came to mind. So I've worked at several major brokerage firms and also a major insurance firm. I've worked at Smith Barney, which is where I got my start at 23 years ago. It's changed names several times. When I got hired, it was Smith Barney. I then went to Payne Weber, also has changed names. And most recently, the most recent firm Fortune 100 firm that I worked at was New York Life Insurance Company. And I was a registered representative, which means I was licensed to sell securities. So I was also a part of NY Life Securities. While I was there, I had a grandmother call me up and tell me that she wanted to provide for her grandchild, her newborn grandchild, something that would pay for his college, that would help him either when he bought his first home or decided to get married, and something that would replace Social Security, because she was of the mindset that Social Security is not going to be around forever. I have a different opinion on that, but that's not what this webinar is for. So she wanted to do something that would cover all three of these things. And she didn't feel as though she'd be around even the year he got to college. So she wanted to set up a program immediately and fund it. Now, at that time, every year, there is a maximum amount of money that one person can gift to another person without paying any taxes on it. So in this current year, right now, as we're speaking, it's $15,000. I think when she and I were talking, it was $13,500, if I'm not mistaken. So I told her, I said, we got many choices. So the great thing about financial services is there's always choice. I have a saying that there is no such thing as a bad financial product. What there are sometimes are bad financial marriages. So most people know what a CD is. A CD is a certificate of deposit. You can get them from any bank. Most people would agree that a CD is a very safe, almost guaranteed. It's backed by the FDIC for the bank and everything. People would say that CDs are great investments or great ways to save your money. Well, let me tell you this, or ask you this. If I, if you came to me and said you want to buy a house in 9 months and you have some money and you want to grow it, but you need it in 9 months, and I put you into a 2-year CD, does that make sense for you? Does that work? No, it's a bad marriage. It doesn't make a CD bad. It makes the CD that I propose to you bad. Likewise, if I told you, let's put the money into an S&P 500 index fund, 9 months, I can't with any certainty predict what's going to happen over the next 9 months. Maybe the market doubles. Maybe it goes to zero. Who knows? It's a bad idea for someone with a 9-month time horizon. So once again, I've heard story after story after story. You get these financial pundits who sell books and subscriptions and things by preaching fear. And they tell you about all these bad products. Stay away from this, stay away from this. There's no such thing as a bad product. The SEC does a marvelous job of policing what is available to the public. There are things that you shouldn't get involved with because they're above your pay grade, they're above your ability to contribute, they're above your intellectual capacity. That's fine. Doesn't make it a bad product, makes it a bad product for you. I have long since I got into this business, been familiar with the company that they do not believe in whole life insurance. I won't say the company's name. I will say that the company that I worked for, Smith Barney, was owned by a parent company called Travelers. And Travelers also owned this company. So you guys can do a little research, find out the companies that Travelers owned in 1997 when I got into the business, and see who I'm talking about. This company, and I actually loved the mission of this company because at the company I was at, Smith Barney, you had to have $100,000 of investable assets for me to be able to open an account for you. A lot of my friends didn't have 100,000. I was fortunate to start working with professional athletes, entertainers, and in college endowment accounts. So I was able to build a pretty good practice. But my friends I went to college with, anybody I grew up with for the most part, they couldn't call me and open an account. So I was giving them free advice, which 23 years later, I'm still giving free advice here on the internet and through Wealth Our Way. So this company's mission was to go to the underserved, go to people who didn't have $100,000 and help them out financially. The problem with this is, and it's one of my favorite lines from the movie Wall Street, the first Wall Street, where Michael Douglas' character, Gordon Gekko, says, "A fool and his money were lucky to get together the first time." When you have a financial professional coming and sitting in front of you and they've been educated at all, they don't have to be great. They know some things. They normally know more than you. There is right off the bat a competitive disadvantage. They're trying to sell you something which may or may not be in your best interest. Now, here's another little anecdotal saying that I've heard. When a craftsman only has a hammer, everything in the world looks like a nail. What that means is when you got one tool in your bag, you think it works for everything. At this company, they don't sell whole life insurance. So guess what the devil is to this company? Whole life insurance. And they go by the mantra of you should never, ever, 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 ever have whole life insurance, no matter who you are, no matter how much money you make, no matter how much your tax bracket is, no matter how much you can afford. It's stupid to own whole life insurance is what this company tells their employees, and then their employees tell the world this. That's reckless and dangerous. I think back to Star Wars when Obi-Wan Kenobi told young Anakin, only a Sith deals in absolutes. So these cats are all Siths, I guess, because they deal with an absolute. They will tell you that Northwestern Mutual, Guardian, Mass Mutual, New York Life, True Blue insurance companies that are also mutual companies that are owned by the policyholders, that these companies are all the devil because they sell whole life insurance. That's what this company would have you believe. And you're stupid if you own a policy. So they go around and they tell people you should just buy term insurance, which is significantly less expensive than whole life. I agree, it is. And the difference between what you pay in term and would have paid in whole life you should invest that difference in some mutual funds because they sell mutual funds. Well, that concept is called buy term and invest the difference. And what we're going to do today is we're going to examine the difference between buy term and invest the difference and cash value life insurance. For cash value life insurance, there's many different kinds. I'm going to focus today on a limited pay 15 policy. That means you pay it for 15 years and you never pay it again. That's what I'm going to focus on today. So I'm going to show you a comparison of a 15-year pay-in to a life insurance policy versus paying money into a mutual fund. I'm going to give the buy term and invest the difference cat some breaks. I'm going to make this argument easier for them because I don't want to over confuse the issue. I'm going to not put some things in this comparison that would only hurt the buy term and invest the difference people. So the first thing I'm not going to include is the cost of the term insurance. Because if you're buying term and investing the difference, you would be spending money on term insurance. I'm not even going to say that they spent money on term. I'm going to let them invest the whole amount that the other person is putting in the premium. So that's one advantage for the buy term invest the difference. The second thing I'm going to do, I'm going to show you an illustration of this life insurance policy where the client is taking this money out. I'm not going to show you it coming out of the investment account. So in reality, let's just say, for example, I'm going to show you where the person takes out $30,000 a year for 4 years to pay for college. I'm not even going to take the $30,000 out for the 4 years over here. That's how many advantages I'm going to give the buy the term and invest the difference people. Only because for me to do that would confuse all hell out of you. So I'm just telling you ahead of time the advantages I'm giving this side. I'm not going to show you how much term insurance would cost for those years, and I'm not going to take out the same withdrawals. What I'm going to show you is that at age 87, so we're going to start this woman's grandchild as a newborn, which is what she was, and we're going to take her to age 87. I'm going to show you how much money you would have gotten from the whole life strategy versus how much money you would have gotten from the buy term invest the difference strategy. Now I'm going to bring up some very valuable points that I'm going to write on the screen so you guys can see these things. So I finally was taught how when I share my screen to not have the Zoom thing at the top. So we're going to try that right now. We're going to share my screen. We're going to go with the whiteboard and we're going to go with share. Okay. So the first thing I'm going to do is I'm going to remove this thing that's driving me crazy. Okay. So now I'm able to write on my whiteboard. When we talk about buying term, okay, let's see what's going on here. Let's go back. Man, this is not cool. It won't let me write on it. Okay, I don't need to. Let's do something completely different. Let's just go right into the example of what the contributions would be for the insurance policy versus the investment. I'm going to verbally tell you what I was going to write on the board, which I've already covered, but I wanted to have it up there for you to see. These are the things that the woman wanted to accomplish. The first thing she wanted to accomplish was she's giving money to a child. So let's explain this to you. If I'm trying to accomplish something for a client, I actually want to do what the client wants to do. Going back to my example of a hammer and a nail, when certain people come into your living room to talk to you about finances, you have to be leery of what you tell them you want versus what you hear them say they are going to do. A lot of times, and I'm a salesperson, I was very, very well trained to sell financial products. The sales training is so good that I can convince you that what I'm telling you to do is the right thing, and what you actually want to accomplish is the wrong thing. So the first thing this lady said was she wants to give her grandchild 15, or I'm using 15,000 in today's example, $15,000 a year. You cannot. So one of the arguments that the person who was talking to me last night said was that you could put the money in a tax-free account. I would like you guys to tell me, anybody can figure this out, what tax-free options a baby has when they're investing. Because the tax-free options that I know of are a Roth IRA, municipal bonds, or cash value life insurance. If I use a traditional IRA, I'm deferring my taxes. I'm not removing them completely. I'm simply deferring them. I'm going to pay taxes one day. If I use what most people use, which is a UGMA or UTMA brokerage account, taxes are due every year. Now, they're a very low tax rate when the child is young, but when they reach adult age, which this illustration is going to go to age 87. So this person will not only be paying taxes on what's in their gift account that their grandmother gave them, they'll have a job, and that job will give them income, and they're going to have a tax rate. So one of the main reasons people, wealthy people, more importantly, choose to put money into whole life insurance, guaranteed guaranteed universal life insurance, variable universal life insurance, or index universal life insurance, is because they love the tax-free nature of it. When you start making money, like I do, you pay a lot of money in taxes. When you want to minimize taxes, you start to look at the after-tax return. The after-tax return is really all that matters. It doesn't matter how big my nest egg is when I go into the nest egg, if I have to give half of it to the federal government. So she wanted to put the money into a 0-year-old's name. You can't put money into an IRA for a 0-year-old because they don't have any earned income. There's such a thing as a custodial IRA. You can open an IRA for someone under the age of 18. I'm not telling you can't, but by definition, you can't have an IRA if you don't have earned income. Most babies that I know don't have jobs. So the conversation got heated on Instagram last night. The major reason it got heated was this person was giving advice without knowing Shine's personal financial situation. That's my biggest problem with most financial pundits. When I get on this show, I tell people, I'm speaking in generalities. You need to consult with either me or another financial professional about your personal situation. I can't give one size fits all financial advice. I can give you a hypothetical. I can point out the details of the hypothetical character and see if that matches you up, which is why I always solicit people to tell me about their situation in an inbox or on my Wealth Our Way site, and then I'll create a hypothetical based on their site. I did one earlier this week on mortgages for a very good friend of mine. So the first thing she wanted to accomplish was giving money to someone who was 0 years old. There's no tax-free way to do that. So that's going to be a taxable account. That brings in a huge burden. The next thing she wanted to do was she wanted to have some certainty around college. She wanted to have some certainty around 30 years of age for a first-time home buyer purchase. And she wanted there to be money when the person retired. I'm not going to go into the retirement part. I'm going to illustrate it. But for what I'm about to say now, I'm not going to even address the retirement part. The reason being, a baby is 0. Full retirement age right now in America is age 67. I'm here to tell you that any investment that's, trackable and traceable over the last 100 years has a pretty good time to get where it's supposed to go in 100 years. So my bigger concern is 18 years out when it's time for college and at age 30. A couple of things have happened just this year. In March of this year, the S&P 500 went down 30% or there's about in a week. I had clients who have millions of dollars in 529 plans, which is a tax advantaged plan to save for college. Now that's another plan this lady could have used for her child, for her grandchild, but now she's solely limiting that money for college usage. And remember, she had other goals for this child: first-time home buyer, retirement. So it wouldn't have checked every box. Going back to this 529 example, I've had clients that have millions of dollars in 529 plans. They have multiple kids. They funded them well. They're retired pro athletes. And in one day, they watched their 529 plan for a child that's about to go to college 6 months later go from $800,000 down to $460,000 or $560,000. That's heart-wrenching. So one of the other flaws with the buy term invest the difference strategy is investor psychology. Investor psychology, we're supposed to want to buy things low, sell them high. That's what makes you money. Unfortunately, most investors don't do that. Investors panic. And what they do is they sell low and they buy high. How many of you watching this, either this year in March or go back to 2008 or go back to 2001, saw something dramatic happen, the market go down 10, 20, 30, 40%, you get freaked out, take all your money out, wait for it to come back, and when you see that it got back to where it was before, put your money back in. Big no-no. You did the opposite of what you should do. But I understand investor psychology. I've worked with investors for 23 years. People don't always do what they're supposed to do. It's hard for an advisor even to keep in the market when they're scared that all their money's going to go away. So the thing about giving someone a plan, for those, I weigh 390 right now. I've lost 160 pounds. I've been over 500 pounds for 20 some years. I've tried everything. I got money. I didn't have no surgeries, but I've hired trainers. I've went on every diet. I took injections. None of it worked. It didn't work until I found something that would work for me. Every bit of investment advice doesn't work for everybody. So you tell somebody everybody should buy term and invest the difference. That might not be for everybody. The thing that I like about putting people into plans where with cash value life insurance, there are tremendous penalties for getting out of your plan early. They're called surrender charges. You don't want to pay them. I show people, and I'm going to show you when we go on the illustration, how much money you would be giving away to quit your plan. And that is what made people stay with the plan, because don't nobody want to pay those surrender charges. In the buy term and invest the difference, I've seen people stop investing in their buy term and invest the difference plan because a new phone came out and they wanted to buy it, and they had a choice between putting $300 into their investment account or buying a phone for $300. The phone wins almost every time, let alone if Beyonce and Jay-Z come to town. You best forget that the investment plan is not happening. We going to the show. So I love to set plans in motion that make people stay disciplined, right? So for me, with the weight loss, I started doing videos every Monday, Wednesday, and Friday from the gym. I don't like being embarrassed. So I'm going to show up to my video or somebody's going to clown me. That was a accountability thing for me. I also spent a bunch of money on clothes that were way too small for me. Had to get down to them. Then the biggest catalyst for me is I had some arthritis in my knee. I had to lose weight so that the knee didn't hurt. These things finally made something work that otherwise had never worked. When you're thinking about investment plans, 90% of my job is psychology. It's trying to get you to do what you know you're supposed to do, but you don't want to do. We are designed as human beings to be more focused on what's going on today than we are what's going on 20, 30, or 50 years from now. That's our design. Think about cavemen, or in the village, saber-toothed tiger coming anytime now. We got to be prepared to protect ourselves today. And when that tiger comes and we kill it, we eating all of it today. We're not worried about what happens in 12 months. Are we going to have enough tiger meat? We just got to kill the next tiger. That's our human psychology. It's the same way when I'm trying to get people to look into investments. I want you to think about your 70-year-old self, your 80-year-old self, your unborn child going to college. You worry about the new Manolo Blahnik shoes. You worried about the Popeyes chicken sandwich. Like, you worried about all these different things that you need today when I'm trying to get you to think down the road. So buy term and invest the difference. On paper, it sounds great, but try keeping somebody in that plan year in, out, year in and out, year in and out. It's very difficult. I'm telling you, as a person who's worked with all types of clients, it's very difficult. So let's take a quick look. One of the things that the gentleman said last night when he was trying, I was telling him that the stock market historically returns around 10% a year. It's actually under 10% now. But I was telling them that from the beginning of time, it's over 100, a beginning inception of the market, over 100 years, that it's returned a little under 10%. Now, this is a little finance 101 for you guys. Stay with me. When the stock market goes up, there's a couple of things that are happening. The actual share price is going from a lower number to a higher number. So your share of Nike may have went from 40 to 50. Also, companies pay out cash in the form of a dividend. Some companies do, not all. Well, when you are talking about the return of the S&P 500 historically, I am talking about you taking that cash that the stock paid out and reinvesting it into the stock. It's a concept called reinvesting the dividends, and you'll see it on the screen I'm about to share. If you don't reinvest your dividends, 10% is a dream. 10% happens when you reinvest the dividends. So you're not taking any money in the short term out of your portfolio because you're letting it all refocus on it. So this gentleman told me that over the last 30 years, the market has returned 13% and change. Let's see if he's right. Okay, so I'm in prayer right now that you guys all see the S&P return calculator. Anybody who's watching this who does not, by all means, give your man a call. So with that being said, let's actually take a look at what the S&P has done for the last 30 years. Now, it tells you right here that the last data is October 9th. So we can't go past October 9th. So the ending month for this will be September of 2020, because we can't go past October. Well, what was 30 years from September 20? August 1999. Okay. Because 2010, am I right? Nope, wrong. August 89. Why my fingers are fat? Okay. So let's calculate. If we look at from 1990 to 2000 is 10 years, 2000 to 2010 is another 10 years, and 2010 to 2020. If you reinvested the dividends, the return is 10.226, not 13%. If you did not reinvest the dividends, it drops all the way down to 8%. I stand by my statement that if we are looking at data, now I went to school and studied mathematics. I studied a part of mathematics called actuarial science. It's the mathematics of the insurance industry. You are taught that the larger the sample size, the better predictability you get from the data. So he's choosing a 30-year period, happens to be a pretty good 30-year period. If we go back longer than that, we can get numbers that get us down to 11% if we go back to 1970. If we go back to the beginning of the market, though, this is where we hover around that 10% with the dividends. So I always tell people expect 10%. We're not seeing 13% from the S&P 500. So With that being said, let's now go to the illustration. The first thing I want to do is I want to show you how much money you would get if you put the gift amount that this lady that came into my office. I'm not going to use Shine's example because that's her personal business. I'm going to use this person who came in and wanted to do this for her grandchild. So I'm going to go to this illustration, and this just happens to be the illustration software that I'm still able to use from Mass Mutual. And it could be Mass Mutual, it could be New York Life, it could be Northwestern Mutual. I had a brokerage relationship with all of them. And let's look at illustrations. Now, I told you the product that I wanted to talk about was the 15 whole life. You see the line I have written there, 15 whole life. So we're going to just call this client $1 million baby. It's a female. Let's just pick a birth date this year for a new baby. So now we have new baby, female, age 0. I'm gonna walk you right through this. This is the same thing that an insurance professional would do when they're building something for you. Now, I happen to know, because I cheated, I did this earlier so that I wouldn't be messing around with the numbers too hot. I know that the number that I want to get is $2,225,000 of face amount. The way the dividends will be paid in this policy, they will be reinvested into the policy and buy more insurance. That's called paid up additions. The dividend rate is what the current rate is. Now, here's something you need to know. Just like the stock market is not guaranteed to give you a certain return, insurance companies do not guarantee you that they're going to pay a dividend, which is why I tell you to be careful what insurance company you work with. When I was at New York Life, the last time I was there was last year. I left in November, 175th anniversary this year. They've paid a dividend for over 170 years. Now, I can't tell you if there's going to be wind in the air tomorrow or sun on the earth tomorrow, but it's happened for the last 175 years. I'm pretty confident that it's going to happen, but I won't guarantee it. Dividends do get paid, they get cut, they get raised. Dividends are tied to what the current interest rate environment is in our country, and currently interest rates are at historic lows. So there's not real places for interest rates to go but up, or at least stay the same. There's not a lot of downside. So if you get a policy illustrated to you today, the odds that that policy will live up to its illustration are better now than they would be in a higher interest rate environment, but it's still not guaranteed. Let's be clear on that. But neither are stock market returns. What are our options? I'm only checking my phone because I'm making sure the screen is too small to see the numbers. Appreciate that feedback. Okay, so product type, non-qualified. We talked about that earlier. What's qualified? Qualified means it has a special tax treatment like an IRA or a 401k. This is non-qualified. Who is the policy owner? Is it the baby? No, it's not the baby. It's someone other than the insured. The owner's age, in this case, the owner, I want to say she was 60. And her tax bracket, she made that money. Her tax bracket was 35. Riders are something you can add onto an insurance policy. We're not going to do any of that. Now let's talk about the disbursements. Are we going to take money out this policy? Hell yeah. So there's a couple of ways for you to take money out of a life insurance policy. When you are paying money into a policy, it's growing cash value. And it's also, as I showed you earlier, you're buying paid up additions. You can surrender portions of the policy and just take your money back, or you can borrow against your policy. So what I'm choosing to do is to surrender at first, and then when I reach my pay-in number, I'm going to stop surrendering it, and I'm going to take a loan. You'll see how that's illustrated in the illustration. So it's called switching at basis. It may be somewhat complicated for those of you who have no idea how insurance policies work. please inbox me afterwards or go on the Wealth Our Way page and fill out an information form, and I'll do another live that focuses on this. Now let's talk about the disbursements. What I want to do is start the first disbursement when the baby is 18 years old, and I want to take it until the baby's 21, and I want to take $30,000 out a year to pay for college. From age 22 to age 28, I want to take nothing out. From 29 to 29, I want to take one $50,000 withdrawal out. From 30 to 66, I want to take nothing. And then from 67, actually, this should be 65, if I'm not mistaken. We'll see it when I get there. For 20 years, I want to take out, what do I want to take out? $60,000 a year. Let's see how that works for us. Let's see what the results, well, we got to fix this first. All right. So let's use me. All right. Green giant. Oh, I had lunch. It was vegetables. Okay. So in this example, we're at 14,196. I think in my example, I was using $14,355. So this is off by 100 and some bucks a year. I'm not tripping over that. So let's just go with this one. With the $2,225,000 initial death benefit face amount, which we don't really care about because we're not thinking about our brand new baby dying, we're going to look and see. So this is one of the main reasons people speak ill of life insurance. Look what happens in the first year. In the first year, you contributed $14,196. If you changed your mind in the first year and said, give me back my money, they're only giving you back $3,360. One of the greatest investors in this country is Warren Buffett. Warren Buffett says, make all purchase decisions very, very reluctantly, and then never make a sale decision. So I tell all my clients, don't get involved in something that you're not 100% sure you're going to stick with. I've had situations, though, where people swore up and down they could afford something, swore up and down they wanted to do something, and come back the next month, the next year, 3 years in, and say they don't want to do it. They pay the penalty. But we went through it very, very, very vigorously to make sure that what they were telling me was right. They changed their mind. When you look at insurance, there's a lot of expenses in insurance, which is why people who don't like insurance don't like insurance. There are a lot of expenses, but I'm here to show you there are a lot of expenses in everything. Let's not just pick on insurance. Let's talk about everybody's expenses. But you can see, as you start contributing to this policy, the net surrender value does go up. But even after 10 years, this woman would have put $141,960 into this child's policy, and it would only be worth $113,612. Now, if she had a 10-year goal, this is horrible for her to do, and I would have told her such. But she didn't have a 10-year goal. Her first concern for taking money out was when the kid goes to college after they graduate from high school at age 19. So at the end of 15 years, let's look at this column. This is contract premium. They're done contributing at the end of the year 15. At the end of year 15, there's no more payments due. It's not like this has numbers in it and somebody has to pay it. It's just done. It's done at 15 years. Now in year 19, they start taking money out. The first thing they do is they surrender $30,000 of value. That's why it's under the annual surrender column. They took no loan. The next year, they took $30,000 out. And I'm on my live, dog. Hello? Hello? Yeah, I'm on my live. Can you hear me? Are you? Look at the message I sent you. I can't see the messages because I'm on the Zoom. No, I texted you. Okay. All right. Bye. All right. Bye. So the I also can't see what you're typing in no calculator. Okay. Y'all can't see the stuff that I'm showing y'all. That makes this very, very difficult then. So if you can't see this, and I'm not sure why you can't, that defeats, very, very much defeats the purpose of what I'm trying to do. So let me write it in because you can't see what I'm doing here. Damn, this sucks. I thought I had my technology mastered today. I'm very disappointed. Let me see something. Can we bring back the floating screen? All right. So I'm being told that you guys do not see the screen that I am presenting. I am so flustered and sick of technology. I wish that we were not in COVID so I didn't have to keep trying to do these things on Zoom. I am showing where the 30,000 comes out for 4 years and you still have over $183,000 left in this policy. And then at age 30, when you take 50,000 out, you still have over $250,000 left in the policy. And then lastly, when you get to age 67, you start taking out 60,000 a year and you have millions of dollars in the policy. But you can't see any of that. So that doesn't help you guys any. So let's go back to the actual Zoom itself. Where is my Zoom meeting? How do I get back to? I think that I should not be allowed to do any more Zoom meetings. The whole concept of coming from Facebook Live to Zoom was so that I didn't have this problem and that I could share my screen and give people extra information. And now I'm unable to do that. So I'm going to try to do it by writing on the screen and see if that helps everybody. Give me a second while I figure out how to get back here. Okay. So at this point, I can't even get my damn screen to come back for my Zoom. Let's try this. Here we go. What I'm going to have to do, unfortunately, and I know you guys buried with me for a very long time, I'm going to have to record this separately and resend it out so that you guys can see in print and in video what I'm broadcasting, because it's not coming up on the screen. I am literally going through a whole presentation here that no one is seeing but me. So I'm going to go back to stopping the screen share now. And I'm going to try one more thing here. And then if that doesn't work, I'm off of this completely. What I want to show you guys is what the money would grow to in an investment account. Can you see that? Someone text me if you can see this screen right here. So if the person were to put the money into a taxable investment account and earn 7% after taxes, they would have accumulated $363,400 by the time the person was 15 years of age. I'm hoping you guys can see that. I have no confirmation as to whether you can or cannot. I'm waiting for a text. Yes, they can see that. Okay. So you see that they would have 363,400 in a taxable savings account. What I would simply do from that point is take that $363,400. I'm adding nothing to it. I'm increasing nothing. And now I want to go from age 15 to age 65 in retirement, 50 years. And I want to get a 7% before tax return, because that takes into consideration the expenses and sales charges in the mutual funds. And I give the person a 25% marginal tax bracket because they pretty much have a job and they have $300,000 growing. And I calculate that. And that grows in a taxable savings account to $4,693,428. That's how much money this lady's contributions, if she put $14,355 into an account for her granddaughter, it grew for 15 years, and then she took the lump sum out, put it into something else that now the child's, working after college and it's being taxed. When that child reaches age 65, they didn't take anything out. They didn't take this college money out. They didn't take the first-time home buyer out. They didn't take any retirement payments out. They have $4,693,428. Unfortunately, y'all couldn't see the insurance illustration, but in the insurance illustration, this person took out $30,000 for 4 years for college, which is 120 grand. They took out $50,000 one time at the age of 30 for a first-time home buyer program. And then they took out $60,000 a year for 20 years in retirement from 65 to 85. All total, they took out $1,370,000. At that point in time, when that child is now 80 some years old, the death benefit on the insurance policy is $5,281,000. If you add $5,281,000 to $1,370,000, you're talking about $6,600,000, all tax-free, $6,600,000, all tax-free, and the person contributed $215,000. When this person has this mutual fund and they die, now here's where the problem with the buy term and invest the difference comes in. Try finding a 85-year-old who actually has term insurance. Doesn't really exist. It's very, very rare because term insurance is incredibly expensive when you're 80 years old. So now that person is going to die with no insurance. They're going to leave an estate to their heirs, and then that's going to be taxed. I'm not here to tell you that buy term and invest the difference is horrible. There are a certain group of you who that's exactly what you should do. There's also a certain group of you that should never do that because your financial situation is different. So with that being said, let's stop the screen share. It's 12:54. I said I'd go to 1. I'm utterly disappointed that I couldn't illustrate the life policy. So I'm going to post the life illustration in picture form on the Wealth Our Way Facebook page. So then you've seen the taxable illustration. And I didn't take out anything for college. I didn't take out anything for first-time home buyer. I didn't take anything out to replace Social Security. I didn't take anything out for the life insurance premiums for the term. And it still was in the same ballpark, actually a little less than what you got in the whole life. Here's my whole point of all of this as I let you go because I'm 5 minutes left. The reality is that you need to know what your situation is. And if you don't understand what your own situation is, you work with someone who can tell you. doesn't have to be me, but you work with someone who's not going to profit off of the tool that you end up using. You work with someone who's a planner, who can say, hey, you can go buy mutual funds, but here's what's going to happen if you do. You can buy life insurance. Here's what's going to happen if you do. You can go buy Bitcoin if you want. Here's what's going to happen if you do. And that's how you make your financial decisions. Having someone get on Instagram and try to tear down a strategy that someone else used, someone, I'll be honest, I don't know this cat, but if they work at the firm that they advertise that they work at, they have what's called a Series 6. A Series 6 is like playing overseas basketball versus a Series 7, which is like playing for the Lakers. So this cat's not even in the ballpark to really talk about. He should, come over here and let me coach him. But in reality, he wanted to get into an argument. I invited him to a live duel on Zoom. He, of course, said no. So just wanted to let you guys know that I will post the insurance numbers so you can literally see in black and white what I'm saying and compare it to buy, term, and invest the difference. Everybody has a lane. We have to find yours. For more information, when you guys are interested in finding out about all things financial planning, please visit www.wealthourway.com. You can also check in on our Wealth Our Way Facebook page, Instagram page, Twitter, LinkedIn, YouTube. We're everywhere. I just don't know how to use any of it. I'm good with numbers. I'm going to talk to my team about me getting better Zoom dominance, because I like to dominate and the Zoom thing is not working out for me much better than the Facebook Live was not letting me share my screen. So we'll figure it out, because I'm going to keep evolving this thing until I give you guys exactly what you need and what you want. So this was my first attempt at a webinar as opposed to a 15 minutes of finance. Let me know what you liked, what you didn't like, and we'll keep making this thing better. You guys take care.